Okay, let's get into it. Welcome back to the Deep Dive. Today we are unpacking the WD-40 company, that's ticker WDFC, and their Q1 fiscal year 2026 earnings call.
Yeah, this one is a really fascinating case study. It's what I'd call a classic Staples execution debate.
Exactly. I mean, on one hand, you have this management team that sounds incredibly confident.
Yeah.
But on the other, the immediate market reaction was, well, it was brutal.
Oh, absolutely. The stock dropped about 9.5% in after-hours trading. For a brand like WD-40, that's a huge move.
It is. It really signals some deep investor skepticism.
Right. And the story here is all about execution. Everyone knows the brand is iconic, but the real question is, can management deliver those clean, consistent quarterly results the market expects?
So let's start with those headline numbers that caused all the commotion. The top-line sales figure was $154.4 million.
Which was, basically flat, up 1% year over year, but it did just miss the consensus estimate.
Barely. Less than $1 million off. But that wasn't the real problem, was it?
No, not at all. The GAAP EPS, the earnings per share, that's what really triggered the sell-off. They reported $1.28.
And the street was looking for $1.45.
Yeah, that's an 11.4% miss. That is a significant shortfall, and it's what the algorithms and the initial traders latch onto.
And that kind of miss suggests something broke on the way from the top line to the bottom line. Operating income was down 7%, net income down 8%.
It was a clean miss across the board. And when you're a premium valued defensive stock like WD-40, investors just don't tolerate that kind of volatility. They are paying for certainty.
Okay, but this is where it gets interesting, because if you just look at the headlines, you miss the real nuance under the hood.
You absolutely do. And that brings us to what you called the margin paradox, because the core profitability of what they sell is actually doing exceptionally well.
Let's talk about that. Gross margin hit 56.2%.
Which is fantastic. I mean, that's up 140 basis points from last year, and it's already well above their long-term target of 55%.
So if they're making more profit on every can they sell, why did the EPS fall off the table? Where did all that money go?
Right. So first, let's look at what drove that margin strength. About 110 basis points of that gain came from lower input costs. Think cheaper specialty chemicals, cheaper aluminum for the cans.
Okay, so a tailwind from falling commodity prices.
Exactly. The other 60 basis points, though, came from higher prices and selling more of their premium specialist products. That part is structural.
That's a really key distinction. So they're getting help from the market, but also creating their own margin through pricing.
They are, but the problem is all of that wonderful gross margin gain was completely eaten up further down the income statement.
Which brings us to the cost of doing business, the CODB.
Precisely. Their CODB spiked to 40% of sales. Last year, it was 37%, and their target is supposed to be between 30 and 35%. That 3% jump is the entire story of the earnings miss.
Management called it an anomaly. But you and I know that investors hate that word. So what were they actually spending on?
They broke it down into a few key areas, and they framed them all as strategic investments. First, they hired more people, specifically in sales and R&D.
Okay, investing in growth.
Right. Second, a lot of one-time expenses for things like global strategy meetings and increased travel, getting the teams aligned for the year.
And the third piece was IT systems, if I remember correctly.
Yes, and that's a big one. They're spending a lot up front to upgrade their ERP systems and supply chain tools. It's a huge expense that hits hard in one quarter, but it's essential if you want to scale globally.
So management's argument is that this is just some lumpy front-loaded spending, and it'll normalize later in the year.
That's the argument. The core debate for investors is whether this is smart planning or just, poor expense management.
To figure that out, we have to look at the top line again, at the sales mix, because that flat number hides a really strong core performance.
It absolutely does. If you look at their direct markets, and that's the vast majority of their business, about 83% maintenance product sales there grew by 8%.
8%. That's right in line with their long-term targets. That's a healthy number.
It's a very healthy number. And their higher margin stuff is doing even better. The WD-40 specialist line was up a huge 18% globally.
And e-commerce was up 22%, also driven by specialists.
Yes.
So, wait a minute. If the core business is growing at 8% and the high margin growth engines is up 18%, how on earth did they end up with consolidated sales growth of only 1%? Where is the drag?
That is the million-dollar question. And the answer is entirely in their smaller marketing distributor network. That's the other 17% of their business.
Okay, so what happened there?
The problem was basically all in Asia Pacific. Sales there through distributors were down 10%, and the classic multi-use can was down 12%.
A drop like that sounds like a demand problem.
It sounds like it, but management says it's purely a timing issue. They explained that in the prior quarter, Q4, they ran really heavy promotions in that region.
So the distributors all stocked up at a discount.
Exactly. So in Q1, they were just sitting on all that inventory, selling it through, and not placing new orders. Management is adamant that end user demand is still fine. It's just this inventory correction creating volatility.
And that explanation is why they're standing so firmly behind their full-year guidance.
It's the whole reason. They see it as a quirk of one channel, not a problem with the core brand.
Okay, so let's pivot to that longer-term strategy.
Yeah.
Because this is where management is really planting their flag. And it starts with simplification.
That's right. They're actively trying to sell their home care and cleaning brands in the Americas, things like Spot Shot and 3-in-1.
So they're shedding some revenue on purpose here.
Yes. It's about $12.5 million in sales and maybe 20 cents in EPS. They want to get rid of it so they can focus 100% of their energy on the core WD-40 maintenance products.
It's a focus play. But the real story they keep telling is just the sheer size of the remaining opportunity.
It's almost hard to believe for a product this old. But they keep hammering this point home. For the classic blue can, the multi-use product, they see a global attainable market of $1.9 billion.
And they've only captured about 25% of that.
Meaning there's still a $1.4 billion growth opportunity out there. That is the bull case in a nutshell.
And what about for the specialist line?
Even less penetrated, they see a $665 million market there, and they've only got 12% of it. So another $500 million plus in one way. This is why they're making those CODB investments we talked about. They're building the machine to go after those markets.
Which brings us to their guidance. Despite the big Q1 miss, they came out and reaffirmed their full-year numbers.
They didn't just reaffirm, they went out of their way to express high confidence in delivering results at the mid to high end of the range.
That is a bold statement after a double-digit miss. They're basically telling the market, don't worry, we're going to make it all back and then some.
They are, and they're backing it up with their capital.
The dividend, for one. They boosted the quarterly dividend by over 8%. That's a strong signal of long-term confidence.
It is, but the even more direct signal is the share buyback. They spent almost $8 million buying back stock in Q1, and they said they plan to use the entire remaining $22 million authorization this fiscal year.
So after the stock drops 9.5%, they're stepping in as a major buyer.
Exactly. They're essentially telling shareholders, we think the stock is cheap right here, and we're putting our money where our mouth is. That $22 million acts as a pretty solid floor under the stock for the next few quarters.
Okay, that brings us to our favorite segment. This is where we pitch an outrageous but plausible trade idea based on everything we just heard. And of course, a reminder. This is not financial advice. This is just us connecting the dots.
And the setup is pretty clear. You have a high-quality company that just got punished for short-term miss, creating skepticism and potentially an opportunity.
My trade idea is this. I'm calling it the divestiture delta buyback arbitrage.
Okay, I'm listening.
The thesis is you fade the market's emotional short-term reaction, and you buy into management's long-term capital-backed conviction. You initiate a long position right in that post-earnings pocket of weakness, say in the $180 to $190 range.
So you're buying the dip. What are the specific catalysts you're betting on to prove the market wrong?
There are three. First is margin defense. That 56% plus gross margin is real, and it gives them a huge cushion. Second is the successful sale of the home care brands, which will simplify the story and let them focus. And third, and most importantly, is that accelerated $22 million buyback. That's guaranteed demand for the stock.
So you're betting that the 8% growth in the direct business is the real story, and the distributor noise is just that noise.
Exactly. You're betting management knows their business better than the algorithms that sold off the stock in the first 5 minutes after the release.
It's a compelling thesis, and it really summarizes the whole conflict of this earnings call. You have this genuine operational success, the margins, the specialist growth, that is just clashing with these short-term execution hiccups.
Right. And so the core question we leave you with is this. WD-40 clearly has this amazing brand, strong margins, and a huge growth runway. But can they translate all that potential into the kind of clean, consistent quarterly results that investors demand? You've heard their strategy. Now, we all have to watch the execution. That's the real deep dive.